How would you like to minimize the amount of taxes you pay on your investments? We all would, right? That's why in this video, I'll tell you everything you need to know about tax advantage accounts to save money on your investments. Hi everyone, Alex Marie here. If you're new to my channel, I do business and personal finance videos, so make sure you subscribe if you're interested and click the bell so you never miss out on an upload, and click the like button because the YouTube algorithm likes those a lot. Personally, I invest in tax advantage accounts and I have no complaints so far. I am making great return on my investments while paying less to no taxes. And in this video, I'll show you how these accounts work so you can start doing the same. Jumping right in, what are tax advantage accounts? Tax advantage accounts are financial accounts where you either defer taxes or pay no taxes on your returns, also known as capital gains. They can be divided into two categories, deferred accounts and tax-exempt accounts. When you have a tax-deferred account, all contributions you make to it are subtracted from your taxable income. Therefore, you pay no taxes on the amount you contributed for a given year. For example, let's say you contributed $6,000 for a tax-deferred account in a given year, and your income is $50,000 annually. Instead of paying taxes on the whole $50,000, you pay taxes only on $44,000 because it subtracts those $6,000 that you contributed to. On top of that, the capital gains you make every single year are tax deferred until you withdraw them from the account. On the other hand, with tax-exempt accounts, you don't receive the same tax breaks you do with tax-deferred. You will pay taxes on the amount you contribute, but, and a big but on that, your investments grow tax-free, and when you withdraw them, you pay no taxes. And that's pretty powerful, not paying any taxes on your capital gains. So let's illustrate this. If you contribute $6,000 for 20 years to a tax-exempt account at 10% return, which is the average yearly return of the stock market, you would have $343,650 to withdraw at the end of the 20 years. From that amount, you contributed $120,000. The rest, which are $223,650, are capital gains that you can withdraw tax-free. If you were to invest that money in a taxable account, you would have to pay capital gains on those $223,650. The majority of people are in the 15% tax bracket, which means that you probably would have paid $33,548 on top of your ordinary income taxes. Can you see how powerful that is? But Alex, what accounts are considered tax advantage? Well, there's a couple. I'll only mention the most common, so here we go. You have the traditional IRA, Roth IRA, traditional 401k, Roth 401k. But before diving into these accounts, I want to know, have you heard of any of these accounts before? Do you have one? Let me know by smashing the like button in this video for the YouTube algorithm. And after you like the video, comment down below and let me know. Let's begin with IRAs. IRAs are individual retirement accounts. Anyone can have an IRA, but there are limits to how much you can contribute per year. For 2020, which is the time I'm filming this video, the max you can contribute is $6,000 per person. If you are 50 years or older, you can contribute $1,000 on top of that. The government calls this to make up for lost time. However, the major setback with IRAs is that you have to wait until you're 59.5, very specific, years old in order to withdraw your money. If you withdraw before then, you will pay a 10% penalty on the amount you withdraw plus taxes. There are certain exceptions and loopholes to these rules, but that is a whole nother video. The difference between traditional and Roth IRAs is when you pay your taxes. Traditional IRAs are tax deferred, meaning you pay taxes when you withdraw, but every single year before then, you didn't pay taxes on your contributions. Roth IRAs are tax exempt, meaning you do pay taxes on the amount you contribute every year, but you do not pay taxes when you withdraw. Now, 401ks are employer-sponsored retirement accounts, which means that unfortunately, if your employer does not offer 401ks, you cannot have one. There are accounts that work as a 401k, and there is a personal 401k, also known as the solo 401k, but that would be too much information. I really do not want to overwhelm you. So we're going to go with traditional 401ks. 401ks, your employer matches your contribution up to a certain percent. For example, let's say you make $60,000 annually and your employer matches 1-to-1 up to 6% of your salary. This means that your employer will match up your contribution up to $3,600 to your 401k annually. In other words, if you contribute $3,600 to your 401k, your employer will contribute another $3,600 to your account for a total of $7,200 per year. And in other words, in more simpler terms, you get free money. And this is why it's a no-brainer to participate in a 401k if your employer matches your contribution. Similar to IRAs, 401ks have a limit to how much you can contribute per year. For 2020 and 2021, the max contribution for 401ks is $19,500. And if you want to withdraw without penalties, you also have to wait until you're 59.5 years old. Again, there's loopholes, but that's for another video. Same thing as IRAs, there's the traditional 401k and the Roth 401k. And the same tax rules apply as with Roth IRAs and traditional IRAs. So quick summary, traditional IRAs and traditional 401ks are tax deferred, while Roth 401ks and Roth IRAs are tax exempt. Now we're going to mention an account that has the best of both worlds. Health savings accounts. When it comes to health savings accounts, or HSAs for short, the contributions you make are tax deductible, which means it's tax deferred. But then when you withdraw your money, you don't pay any taxes, so it's tax exempt. In other words, you never pay taxes. I know, you're excited. This is exciting. But there's a lot of rules that apply here. There's so many rules when it comes to HSAs. So many, in fact, that I'm gonna have to save it for another video. I know, this was a lot. It was a lot of information in one go. I have a headache right now. I know this was a lot of information, which is why I have consolidated everything into a free guide that you can download by clicking the link in the description box below. It covers everything I've talked in this video, plus a few extras. I go into HSAs and I go into solo 401ks, since I couldn't cover everything in this video. I am not a CPA, nor am I a certified financial planner, so make sure you speak to your CPA or financial planner regarding which account is best for you and what investment strategy is best for you. Hit the like button to let the algorithm know that you enjoyed this video, subscribe to my channel for more videos like this, and if you found this video helpful in any way, shape, or form, share it with your friends. Check out the other videos on my channel. I'm sure you'll find something of interest to you. Have a great day and happy investing.